The year was 1992. Global financial markets hummed with activity. But one man, George Soros, saw an opportunity, a crack in the seemingly impenetrable facade of the world's most powerful economies. He bet against the British pound sterling, a currency considered unshakable. His wager? A staggering $1 billion. The outcome? A single day that would forever etch Soros's name in financial history, Black Wednesday. Soros's gamble wasn't driven by recklessness but by calculated analysis and a deep understanding of global economics. He recognized an imbalance, a fundamental flaw in how the British government was managing its currency. This wasn't mere speculation. It was a high-stakes game of chess against an opponent seemingly unaware of its vulnerability. And Soros, the master strategist, was prepared to make a move that would shake the world. The early 1990s were turbulent times for the United Kingdom. The country was grappling with recession, soaring interest rates, and high inflation. To stabilize the economy and control inflation, the UK had joined the European Exchange Rate Mechanism, or ERM. This system pegged the pound to other European currencies, primarily the German Deutschmark, within a narrow trading band. The ERM's fixed exchange rate system, however, proved to be a double-edged sword. While it provided stability, it also limited the British government's ability to control its own monetary policy. Interest rates were kept artificially high to maintain the pound's value within the ERM band, further stifling economic growth and putting immense pressure on the government to defend its currency. The stage was set for a showdown. George Soros, with his keen eye for market inefficiencies, recognized the inherent weakness in the British pound's fixed exchange rate. He believed that the pound was overvalued and that the UK government's commitment to maintaining the ERM peg was unsustainable. The high interest rates, meant to attract investors and prop up the pound, were crippling the economy. Soros understood that something had to give. The UK government was caught in a catch-22. Maintaining high interest rates would further damage the already fragile economy, while lowering them would lead to a run on the pound. Soros saw this vulnerability and decided to act, betting against the Bank of England's ability to defend the pound's fixed exchange rate. His weapon of choice? A massive short position on the British pound. The Bank of England determined to maintain the pound's value and uphold the UK's commitment to the ERM threw its full weight behind defending the currency. They dipped into their foreign currency reserves, buying pounds to increase demand and prop up its value. Interest rates were hiked even further to attract investors and discourage selling. But these measures proved insufficient. The market had lost faith in the pound. Soros and other speculators, sensing blood in the water, intensified their attacks, selling even more pounds. The Bank of England was fighting a losing battle, desperately trying to hold back a tidal wave of selling pressure. The pressure on the pound was relentless, and the inevitable was fast approaching.